Consider this scenario. You own cryptocurrencies, and all of a sudden, the market crashes. Overnight, your investment falls by 50%. Doesn't that seem like a nightmare? However, what if there was a method to use cryptocurrencies without having to worry about their value fluctuating? What if you could have the steadiness of cash with the quickness and security of cryptocurrency? That's precisely what stablecoins are intended to accomplish, and we're going to explain everything to you today. Before we begin, let's clarify that this movie is solely intended for educational and entertaining purposes. Anything you do with your money outside of this video is completely up to you. We are not financial advisors. Although we want to assist you in making the best choices possible, the onus is on you. So let's make it light, enjoyable, and above all, intelligent. Welcome to the world of cryptocurrency, where you can find everything you need to know in an easy-to-understand manner even your grandmother could understand. Well, perhaps not your grandmother, but you understand. One video at a time, we want to eliminate the ambiguity surrounding cryptocurrencies and replace it with clarity. We're delving into the realm of stable coins today, explaining what they are, how they operate, and why they could be the crypto tool you've been lacking. You'll be an expert on stable coins by the end of this video, so fasten your seatbelt. Okay, let's begin with the fundamentals. What is a stablecoin exactly? Simply put, a stablecoin is a kind of cryptocurrency that, as the name suggests, is intended to maintain a steady value. Stablecoins are linked to a stable asset, like as the US dollar, as opposed to equities like Bitcoin or Ethereum, whose prices fluctuate more quickly than you can say HODL. Accordingly, one stablecoin typically has a value of $1 and is intended to remain that way. Stability, without drama or surprises. You may be asking yourself, why are stablecoins even necessary? Isn't separating from conventional money the main goal of cryptocurrency? Well, both yes and no. Although decentralized and safe, cryptocurrencies like Bitcoin aren't exactly the greatest for daily use. Let's face it. If the value of Bitcoin could decrease by 10% by the time you finish your latte, would you still purchase it? Most likely not. Stablecoins are useful in this situation. They blend the stability of traditional money with the speed, anonymity, and security of cryptocurrency, giving users the best of both worlds. Consider them the link that connects the old and new financial systems. They allow you to benefit from blockchain technology without having to deal with its heart-stopping volatility. You may utilize cryptocurrency freely and stress-free with stablecoins, whether you're trading, saving, or simply transferring money. Now let's examine the specifics of how stablecoins function. The first approach, known as collateralization, is quite simple. Consider yourself in a pawn shop. They give you money in exchange for anything of value, such as a gold watch. Stablecoins backed by fiat operate similarly. Businesses such as Tether, USDT, and Circle, USDC, issue one stablecoin for every dollar they hold in their bank account, along with occasionally other assets like gold or euros. Therefore, they can issue 1 million USDT or USDC tokens if they have $1 million in the bank. Here, stability is the main benefit. The value of these stablecoins remains relatively close to $1 because they are backed by actual assets. However, and there's always a but, there are drawbacks. Transparency is the first concern. How can you be certain that the business possesses the funds it says it does? For instance, there have been rumors that Tether doesn't always have $1 for each USDT that they issue. The second is the possibility of poor management. What happens if an employee chooses to embezzle the funds? Although uncommon, there is a risk. Lastly, the corporation is losing out on an opportunity because all that money in a bank account isn't collecting interest. Let's now discuss algorithmic stablecoins, the second approach. These are a little more futuristic and don't depend on tangible assets like gold or money. Instead, they regulate the stablecoin's supply and maintain its value through smart contracts, which are essentially self-executing code on the blockchain. DAI, which is based on the US dollar but not backed by real dollars, is a prime illustration of this. This is how it works. The smart contract will produce more DAI tokens and release them to the market to lower the price if the price of DAI rises over 1. The smart contract will produce more DAI tokens and release the minto to the market in order to lower the price if it falls below 1. The smart contract will repurchase DAI tokens to lower the supply and raise the price if it falls below 1. It resembles a self-correcting main benefit. Anyone can audit the blockchain and see exactly how it operates because everything is done through code. Additionally, there isn't any tangible collateral to mishandle or steal. However, as you were aware, there are dangers. Because algorithmic stablecoins depend on changes in supply and demand in the market, they may be more volatile. Things could become chaotic if the system malfunctions or if if people lose faith in the stablecoin. So which approach is superior? That depends on what you're trying to find. The ideal option for stability and ease of use is a fiat-backed stablecoin, such as USDT or USDC. They are generally dependable, extensively utilized, and simple to comprehend. But if you're all about transparency and decentralization, you might prefer algorithmic stablecoins like DAI. Though a little riskier, they are state-of-the-art. In the end, both approaches have a role in the cryptocurrency industry. Algorithmic stablecoins are ideal for DeFi aficionados who wish to maintain complete decentralization, while fiat-backed stablecoins are excellent for daily use and trading. It all comes down to selecting the appropriate instrument for the task. Let's start with trading and hedging to discuss why stablecoins are so revolutionary. Consider this scenario. You purchase Bitcoin for $10,000, and it soars to $10,000 and then to $50,000 a few months later. Even though you have a sizable profit, you aren't quite ready to cash out. What are you doing? Let's talk about stablecoin. Without switching back to fiat money, you can lock in your winnings by selling half of your Bitcoin for stablecoins. In this manner, you've already protected your gains in case the market plummets the following day. In the unstable world of cryptocurrency trading, it's similar to having an emergency escape route. Let's discuss earning interest next. Stablecoins can help you make a lot more money if you think your bank's 0.01% savings account is a joke, which, let's face it, is. Lending out your stablecoins on platforms like Aave and Compound allows you to earn interest, sometimes up to 10 to 20% APR. Yes, rather of just sitting there, your money may work for you. What's the best part? Price changes are not a concern for you. Your stablecoins remain valued at $1, and your interest continues to accrue regardless of the state of the cryptocurrency market. Lastly, let's not overlook international transactions. With exorbitant fees, protracted processing delays, and copious documentation, sending money abroad may be a headache. With fees that are a small portion of what traditional banks charge, stablecoins, on the other hand, allow you to move money anywhere in the globe in a matter of minutes. Stablecoins make it quick, easy, and affordable to send money to family members who live abroad or to pay for services there. Now, let's discuss the hazards before you fully commit to stablecoins. Lack of insurance comes first. Your money is typically protected by the government when you deposit it in a bank. In the US, the FDIC insures up to $250,000. However, stablecoins, not at all. There is no assurance that you will receive your money back in the event that the stablecoin's parent firm fails or is compromised. Therefore, stablecoins are not as secure as your bank account, despite their convenience. The problem of collateral risk comes next. Do you recall our discussion on fiat-backed stablecoins such as USDT and USDC? Of course, there's always the possibility that the business doesn't have the money they say they do. Rumor has it, for instance, that Tether does not retain $1 for each USDT that is issued. The USDT might fall below $1 if that turns out to be the case and people begin to lose faith. And let's just say it won't be pretty if it occurs. There's also the danger of volatility. Stablecoins are not infallible, even though their goal is to remain at $1. In the event that the algorithm malfunctions or there is an abrupt decline in trust in the system, algorithmic stablecoins in particular may lose their peg. The value of the stablecoin may fluctuate greatly as a result, and you may lose money. Therefore, stablecoins are not risk-free, even though they are typically stable. Now, let's get to the point. Although stablecoins are a fantastic tool, there are risks associated with them. Do some research on your own before you go in. Recognize how they operate, balance the benefits and drawbacks, and only invest money you can afford to lose. Although cryptocurrency is thrilling, it's not a game. Let's be realistic. So use it wisely. Centralized exchanges like Coinbase, Binance, or Gemini are the simplest way to get started if you're ready to explore the world of stablecoins. These platforms are easy to use and ideal for novices. This is how it operates. You sign up, verify your identification. Yep, they'll require your ID. And then you can buy stable coins like USDT, USDC, or DAI straight with your credit card, debit card, or bank transfer. It's as easy as making an Amazon purchase. After receiving your stable coins, you can send them to your wallet, hold them on the exchange, or exchange them for other cryptocurrencies. Just keep in mind that centralized exchanges are custodial, which means they have control over your money, even though they are convenient. Therefore, it's a good idea to transfer your stable coins to a secure wallet if you intend to store a large number of them. Now, decentralized exchanges, DEX, like Unsweep or SushiSwap, are for use if you're more of a cryptocurrency expert and wish to remain completely decentralized. This is how it operates. You must first have cryptocurrency in your wallet, such as Ethereum. After that, you can exchange your Ethereum for stablecoins like DAI or or USDC by connecting your wallet to the DEX. The finest aspect, there is no middleman, no KYC, and no waiting for clearances. You are in complete control. However, bear in mind that DEX can be a little more complex, and you will have to pay gas fees, which are those annoying expenses associated with transactions on the Ethereum network. Therefore, if you're new to cryptocurrency, you might want to continue using centralized exchanges for the time being. Speaking of wallet, let's speak about storage. You should protect your stablecoins after purchasing them. Keeping them on a trustworthy exchange can be okay if you're holding a little quantity, but it's time to buy a secure wallet if you have a sizable quantity in your possession. Hot wallets and cold wallets are the two primary varieties, software-based and internet-connected. Hot wallets include MetalMark and Trust Wallet. Although they are excellent for trade and instant access, they are also more susceptible to hacking. Hardware devices called cold wallets, such as Trezor or Ledger, are used to store cryptocurrency offline. Although they are the best option for security, they are not as practical for daily use. The bottom line? Invest in a quality wallet if you're serious about cryptocurrency. It's better to be safe than sorry, just like when you purchase a safe for your digital currency. Okay, let's finish this. Everything you need to know about stablecoins has been presented today. We began by going over the fundamentals, including what they are and their purpose. Stablecoins are cryptocurrencies that are intended to remain steady. They are typically based on the US dollar, allowing you to benefit from cryptocurrencies without having to deal with their volatile price swings. We then examined their mechanisms, ranging from algorithmic stablecoins like DAI to fiat-backed ones like USDT and USDC. We discussed their advantages, such as trading, interest earning, and cross-border transfers. But we also discussed the concerns. Since nothing in cryptocurrency is completely risk-free, let's face it, looking ahead, stablecoins offer a glimpse into the future of money and are more than just a tool. Stablecoins have the potential to serve as the foundation of a new financial system that is quicker, less expensive, and more widely available as the cryptocurrency market expands. Stablecoins are here to stay, and we're eager to see where they go from here, whether you use them for international money transfers, trading, or saving. Here's your assignment before you leave. Please hit the like button if you thought this video was useful. Even though it's a tiny gesture, it has great meaning for us. Additionally, if you haven't already, enable those notifications and subscribe to the channel. A thorough examination of the 3 algorithms underlying algorithmic stablecoins is just one of the many things we have in store for you. You won't want to miss it, I promise. Thanks for watching, and remember, stay curious, stay informed, and we'll see you in the next video.